The Rebel Capitalist Show.
If you've got someone who is your prime target there, kind of the average Joe and Jane, they don't have a background in macro, they don't really understand Keynesian economics or Austrian economics, or they haven't studied Milton Friedman or anything like this, or that maybe they didn't really study the GFC. How do you present the macroeconomic environment to them, kind of in a step-by-step process to not overwhelm them?
Yeah, that's a great question. Because you do a great job of educating as well, George. And it really is kind of you got to try to meet as many people where they are and then build from there. I find it really useful to just sort of use the Socratic method, which is to speak to, hey, can you see what's going on with prices in your grocery store, right? Or, hey, why is all of a sudden, so much of what the things we want to buy, A, more expensive, or B, not even in stock anymore, right? And then pulling at those threads, because those tend to be sort of universal experiences for people. You can then kind of, begin to talk about the causality of what's actually making that happen. And interestingly, I find that, you got to be careful early on not to overwhelm people with kind of the wonky jargon that you and I like to talk about when we're sitting in a corner somewhere.
The Eurodollar futures curve.
Exactly. Yeah. But people actually enjoy hearing those terms. And you do a great job of this with your whiteboards. I don't have your skill at the whiteboard, but I do a number of what I call sort of explainer videos.
Yeah.
Well, we'll pick a topic and try to explain it within 10 minutes or less, so that people, when they hear those terms going forward, they feel like they've got enough of an understanding to kind of at least follow the story. But the type of person that I speak to, and I imagine there's a high overlap with your audience, George. These are people, most of whom who have built some degree of wealth, which means they tend to be a little bit older. I'm definitely not trying to ignore the millennial or younger crowd, and quite honestly, that crowd needs this information the most because they're going to be the ones dealing with these issues the longest in their lives. Yeah. But I found that these are people who have built some wealth, and they're doing it to take care of those who depend on them. Right? It's their spouse, it's their children, whatever. And that's really kind of their defining motivator, is just, I want to get smart enough so that I can sleep well at night, knowing that I'm doing something smart enough with my money that I'm maximizing the odds of it being there for me, when I'm done. So we tend to skew older. We tend to have a lot of people who are, 45 and older, people who are approaching retirement age or actually retired. And again, it's not necessarily deliberate, but I'm just finding that those are the people who are most concerned about protecting the wealth that they've been working to build.
So it seems like their priority might be capital preservation as opposed to capital appreciation.
Yeah. I mean, be super clear. I'm not, and I don't think you are necessarily either, George, kind of talking to the YOLO crowd, right? We're not telling people when the best time to buy, GameStop calls are, is, or which next NFT is going to be the one to go up by 2,000%. I'm definitely trying to speak to sort of the responsible investor, again, who's really just mostly concerned about just not getting things wrong. We do also, so what Wealthion does is it educates in the way that you and I've been talking about here, but it also then makes that information actionable by connecting people with a network of financial advisors who think look through the same lens, who talk about these issues, who are concerned about them. And I'll tell you, George, it is amazing how many people are frustrated with their current financial advisors. They go to them and say, look, I'm worried about, what the Fed is up to. I'm concerned about the impact that higher inflation might have on my portfolio. I'm concerned about currency debasement. Maybe we should talk about moving some money into hard assets, or maybe even a little bit of gold or silver. And, the average stockbroker out there, basically treats them like they're crazy and says, oh, don't worry about all that stuff. The market's going to take care of you in the long run. Don't worry about that. That's just the doomers. So there is a really sort of pervasive angst for a lot of people out there, right, that they're having trouble finding a good professional steward of their money. And again, that's something that Wealthion tries to help, is connect them with those folks. But it's surprising how badly the current system is servicing their clients.
My biggest concern for people right now, when we're talking about just the financial aspects of life, is the Fed, along with the government, is pushing people so far out the risk curve just to maintain their current levels of purchasing power with their excess productivity, or hopefully their excess productivity, meaning their savings. And hopefully that's not the stimmy checks. Maybe it is, maybe it isn't, whatever. But to protect their savings. You know, I was talking to a guy that was a hedge fund trader. So he really wasn't a macro guy, but really he had done very well in the area of trading, kind of short term. And we started talking about him getting into real estate in 2013, 2014. And he said to me, just kind of randomly, he's like, well, I at that time I knew I couldn't keep my money in the bank. It's kind of nonchalant. And I kind of took pause, and I'm like, you know, he doesn't really even understand what he just said. And subconsciously, he knew that if he kept his money in the bank, that he would lose purchasing power. We've been conditioned to understand that through decades and decades and decades of inflation. Even if it's 2 or 3% compounded annually over 20 years, that's a big number. That's a really big number. That's a big loss of purchasing power. So I thought, you know, back then, the inflation rate, as measured by the CPI, and I know that understates it, but just to give us a benchmark, the inflation rate was, let's say, 2%. And he still knew that he had to do something with his money. He couldn't keep it in a savings account without it losing purchasing power. And I think, what would that same person do today when we've got CPI at, let's say, 7%? You know, now that same inner dialogue would not be, shoot, I've got to do something with it, I'll go into real estate. Because the CPI is so high, especially if you look at it accurately, you're probably not even keeping up with the rate of inflation if you go into real estate. And then you're going so far out the risk curve that you're having to invest in a real estate market that is in a massive bubble, that even adjusted for inflation is higher than the prices were in 2006. So what would you do? The only other option is to, well, okay, now I'm going to go into the stock market, a riskier asset. Well, what happens if inflation goes up to 10% on the CPI? That's not keeping pace. Well, then you're going to have to go, and it gets to the point where if inflation gets high enough, the only option for these people, even if it's a subconscious decision, is to go into Dogecoin, or to go into Shiba Inu, or to speculate on an NFT or something like that. That's what the Fed has done to the average Joe and Jane. So you're an expert in this. So how on earth would the average Joe just maintain their purchasing power, for heaven's sakes, without having to go so far out the risk curve as to buy call options on Dogecoin, if that's even a thing, or GameStop?
Oh, you know, I call this nefarious. I call it actually criminal. I mean, this is not an accident that people are getting pushed out the risk curve like that. It's actual policy, right? You could say that they're responding to the incentives that the Fed policy is laying out in front of them, but really it's a malincentive. I mean, I think most people would prefer not to play this game if they couldn't. But in eras past, if you didn't like what was going on, there were places where you could just sort of sit in safety on the sidelines.
Yeah.
You can't today. As you just very eloquently said, you can't sit in cash, right? Sitting in cash is, right now it's a license to lose at least 8% or at least 7% of your money annually. And we know that official CPI rate is understated, right? So it's probably a fair amount more than that. So I kind of liken it to, kind of like on the old pirate ship plank, people are pushed at sword point out on this risk curve because they can't afford not to, at least in their minds, right? So especially the older generations, right? Where in eras past, you could live well on a fixed income, especially if banks were paying 6, 7, 8% like they were back in the mid 1980s, right? Now the average bank savings rate is 0.06%, which is just, it's insulting. And so, to your point, as inflation rises and the real return that you get from anything quote unquote safe becomes more and more deeply negative from a real sense, you have to go out and reach. And honestly, what you just said there, I know you were kind of joking about going after Dogecoin or the next NFT, but that's already what the millennial generations and younger have learned. That is their only chance. If they want to try to have a hope at affording a middle-class lifestyle, they're not going to get there by capital formation. They're only going to get there by a winning lottery ticket, right?
That's a great way to say it. Yep.
Yeah, and what's also nefarious about this is the Fed has conditioned everybody that there is quote unquote this Fed put, and that the Fed's going to step in if the markets get nervous at all. So the analogy I use is the Fed has been pushing people out onto thinner and thinner ice. But because the ice hasn't broken in so long, right? Besides the 4 weeks in 2020 when everybody panicked about the pandemic, it's pretty much been a decade that if you just trusted the Fed, bought the dips, and just bought and held, you've done great, right? So we push people out on thinner and thinner ice, but they now are treating it like it's concrete, right? Meaning, so they are placing their full faith that it's going to continue to hold them. And as you and I know, there are a ton of macro factors that are highly, highly concerning right now. And when people, basically place all of their future prosperity, out on the risk curve where they shouldn't be, there's a way to, discomfiting chance out there that there could be some breakage. And with people being that exposed, the events could be catastrophic, particularly for people that are sort of, 50 and older, who just don't have the time to recover from, say, a 50% correction in the stock market. And, I'm just not pulling that number out of the air. Number of folks I've talked to, number of folks you talk to, think that a correction of that size or even greater could occur. And, and even great minds like Jeremy Grantham, who, one of the most venerated investors around, the guy is not prone to hyperbole. He thinks at least a 50% correction is possible, given every other time in history we've had the same conditions that we have today. So yeah, I'm sorry, George, I know you painted me as the expert. I don't have the answer for people, but I certainly do have a lot of strategies that people can follow to minimize their exposure to that. Really, I think it's about minimizing loss and risk management at this point in the story. And, I like to tell people, look, given what might transpire in the relatively near term, the name of the game might be preparing to lose money. The strategy is just to lose a lot less than everybody else. That might be the best that we can get out of this. There's going to be opportunities at some point in the story to position yourself to prosper. But given the risk level in the system right now, boy, I'm really nervous.
Yeah, you always got to be comfortable to take a negative carry just so you could have the optionality of dry powder.
Exactly. So, you were talking about, cash and how that just gets eaten away by inflation right now. And I asked this question of the guests that I interview, and most of them at this point right now are saying, yeah, it's a guaranteed loss to inflation, but it's got a very high optionality value, right? So let's say your cash is losing it's going to lose 7% for the next year due to inflation, but let's say the market corrects by 50%. Then you've actually done wonderfully relative to where you might have actually parked your assets, right? So, but I don't mean to say that we should all be happy to sit in cash and lose 7%. It's part of that sort of criminality of the system that's been created when that's maybe the best option that's available to us right now.
Yeah, that's why, just for me personally, I try to keep a very simple portfolio of something I call it 10-80-10. So that just means that 80% of the portfolio pays you to own it. It's like a positive cash flowing rental property. Might not be in the United States, maybe somewhere else, a dividend paying stock. So at least you're getting paid with the majority of your portfolio to buffer the loss, the negative carry that you have on your cash position, to take advantage of something in the future if you think the probability is high.
I totally agree. I think the name of the game going forward is investments that are, safer and less speculative, but very importantly, generate inflation adjusting income streams. And real estate's a really good example of that, where rents usually can go up roughly to match the rate of inflation. I did a video on that, explainer video of that a couple of weeks ago. But I think, George, that honestly, besides, some other really conservative investments and, hard assets, commodities, the type of things that should be somewhat of an inflation hedge.
Yeah.
That's really about one of the best strategies out there right now.
Yeah, I agree.